Navigating the storm, bulletproof strategies to safeguard your real estate investments in uncertain times. Predicting real estate market crashes with absolute certainty is difficult, but if you're concerned that a downturn is coming, there are several strategies you can adopt to mitigate potential losses. Diversify your portfolio. Relying solely on real estate for your investment returns is a risky strategy. By diversifying into other asset classes like stocks, bonds, or commodities, you can spread risk. Refinance your properties. Interest rates are generally lower before a financial crash. If you refinance your mortgage loans during this period, you can lock in lower monthly payments for the long term. Build a cash reserve. A substantial cash reserve will not only enable you to weather the storm but also to take advantage of opportunities that rise during a downturn. Properties may be available at steep discounts, and having cash on hand will enable you to capitalize on these deals. Review tenant lease. In a downturn, vacancy rates often rise and rents can fall. Long-term leases can provide you with revenue stability. If you're concerned about an economic crash, you may want to lock in longer-term leases while the market is still strong. Assess and adjust your risk profile. Different kinds of real estate have different risk profiles. Commercial real estate, for example, tends to be more volatile than residential. You might consider rebalancing your portfolio to include more stable, lower-risk real estate investments. Limit leverage. While leverage can amplify returns, it can also amplify losses. If you're concerned about a downturn, reducing your debt burden can protect you from the risk of foreclosure. Property upkeep. Maintain your property well to ensure that it competes effectively with other rental properties, even in a bad economy. Well-maintained properties are more likely to attract and retain tenants. Consider exit strategies. If you're genuinely concerned about a crash, it might be wise to consider selling some of your riskier or less essential properties. But be cautious. Selling assets in anticipation of a downturn you're not certain about can cause you to miss out on potential gains. Stay informed. Follow economic indicators, understand what's happening in your specific geographic location, and consult with real estate and financial advisors to make the most informed decisions possible. Insure and hedge. Make sure all your properties are adequately insured. You can also consider financial hedges, although these can be complex and are generally recommended for sophisticated investors. Note, these are general strategies and may not be suitable for all individual circumstances. Always consult with a financial advisor or real estate expert before making significant financial decisions. Tax planning. Understanding tax implications and advantages can provide an additional cushion during hard times. Speak to a tax consultant about leveraging tax benefits that are particularly advantageous for real estate investors, such as 1031 exchanges, depreciation, and other deductions. Proper tax planning can save you a significant amount of money. Reevaluate property values and rent rates before a crash. Reevaluate the value of your properties and adjust the rent rates accordingly. If a crash is imminent, it might be difficult to raise rents for some time. Make sure your current rates are competitive but also sufficient to cover costs. Cut unnecessary expenses. Review your expenses to see what can be eliminated or reduced without compromising the quality of your properties. This not only improves your cash flow, but can also make your properties more attractive to potential tenants. Build strong relationships in turbulent times. A strong network can be invaluable. Cultivate good relationships with tenants, neighbors, local businesses, and especially with banks and other financing sources. Being in good standing with your bank can provide you with the flexibility you need in challenging times. Offload non-performing assets. If you have properties that are underperforming or are in locations that you believe will be hard hit by a crash, consider offloading them to reduce your exposure to risk. Revisit financing options. In case you're over-leveraged, contact your lenders to negotiate terms or explore different financing options. Banks are usually more willing to negotiate when they see a proactive approach rather than waiting for you to default on a loan. Strengthen your tenant screening process. A stronger tenant screening process may reduce the risk of vacancies and payment defaults during a downturn. Stable, long-term tenants are particularly valuable in uncertain times. Stay liquid. Avoid locking yourself into a liquid investment shortly before an anticipated downturn. You'll want as much flexibility as possible when navigating through challenging economic landscapes. Seek professional advice. Last but not least, consult with professionals. A team of real estate advisors, tax consultants, and legal experts can provide tailored advice that is most relevant to your situation. The point is to prepare for the worst while hoping for the best. If you're well prepared, you'll not only survive a real estate downturn but potentially thrive by taking advantage of new opportunities. Always consult with qualified professionals when planning for significant economic events to make sure you're taking the best course of action for your individual needs. Contingency planning. One of the most effective ways to prepare for any form of crisis, including a real estate crash, is to have a well-thought-out contingency plan. Outline various scenarios like a drop in property value, rise in interest rates, or increased vacancies and how you'd respond to each. Having a plan in place ensures you're not making panic decisions in the heat of the moment. Diversification. If all your investments are tied up in real estate, consider diversifying your portfolio to include other asset classes like stocks, bonds, or commodities. This can provide a financial cushion when the real estate market is down. Consider rent concessions. During difficult times, you might find it challenging to get new tenants. Offering temporary rent concessions can make your property more attractive to potential renters and could ensure that your property doesn't stay vacant, which would be a more significant loss. Monitor economic indicators. Keep an eye on key economic indicators like GDP growth, employment rates, and consumer confidence indices. Being aware of the macroeconomic landscape can help you make more informed decisions. Regulatory awareness. Stay abreast of any government interventions or policy changes related to real estate. Governments often step in with stimulus measures or changes in policy to stabilize the economy, and these could have a direct impact on your properties. Renegotiate contracts. From property management agreements to contracts with service providers, cleaning, maintenance, etc. Check if there's scope for renegotiation to more favorable terms. Cost saving here can help you keep your expenses low. Tenant retention program. Happy tenants are more likely to stay, even when times are hard. Consider implementing tenant retention programs that reward long-term stays with perks like a month of free rent after a year-long lease. Technology utilization. Love technology to streamline operations, reduce costs, and enhance the tenant experience. Online rent payments, virtual tours, and digital lease signing can reduce administrative burdens and appeal to a tech-savvy renter demographic. Insulate against market risk. Some kinds of real estate, such as essential retail, groceries, pharmacies, and low-income housing, are generally more resilient in downturns. If a crash is expected, pivoting toward these types of real estate might be beneficial. Emotional preparedness. Lastly, don't underestimate the emotional toll a downturn can take. Stress and anxiety can lead to poor decision-making. Being emotionally prepared can help you think more clearly and make better choices. The idea is not just to protect your investments but to position yourself in a way that allows you to capitalize on opportunities that often rise in downturns. Proactive preparation and a well-rounded strategy are key to navigating through a real estate crash successfully. Professional guidance. During uncertain times, it may be beneficial to seek advice from financial advisors, real estate experts, or legal professionals who can provide you with specialized knowledge and help you navigate complex situations. Their expertise can give you new perspectives on how to mitigate risks. Set up an emergency fund. Establishing an emergency fund specifically for your real estate investments can act as a financial safety net. In times of lower rental income or higher expenses due to maintenance or vacancies, this fund can provide much-needed liquidity. Mortgage refinancing. If interest rates are low, but expected to rise significantly in the future, consider refinancing your mortgage to lock in a lower rate for the long term. Just be cautious about the costs of refinancing and make sure they don't outweigh the benefits. Sale and leaseback options. If you're concerned about cash flow, you might consider selling a property and leasing it back. This would give you a lump sum of money upfront, while the leaseback allows you to continue using the property. This strategy is often used in commercial real estate, but can be applied in some residential contexts. Reassess tax strategies. Tax laws often offer avenues to save money, such as depreciation deductions for real estate, that you may not be fully utilizing. Consult a tax advisor to ensure you're taking advantage of all possible deductions and credits. Market timing and local trends. Although timing the market perfectly is impossible, keeping an eye on local real estate trends can help you identify the best times to buy or sell. Some markets may be more resilient than others during a downturn. Exit strategy. In a worst-case scenario, it's prudent to have a well-thought-out exit strategy. Whether it's selling off assets to generate liquidity or collaborating with other investors to mitigate risks. Knowing your exit options can be comforting and financially prudent when navigating uncertain waters. Watch for opportunities. Rally, downturns, and crashes often present unique investment opportunities. Distressed properties can often be acquired below market value. If you've prepared and positioned yourself well, you may be able to expand your portfolio during a downturn. Review and adjust. Finally, the preparation for a potential market crash should be a continuous process. Regularly review your strategies and financial standing, and be prepared to make adjustments as the situation evolves. By taking a comprehensive and proactive approach to your real estate investments, you can better insulate yourself from the significant losses that can occur during a downturn. Remember that the objective is not only to weather the storm but also to emerge stronger once the market begins to recover. Risk assessment. Know what you own. Understanding the risk associated with each property in your portfolio is vital. Carry out comprehensive due diligence, including assessing the local job market, real estate market conditions, and more. During downturns, properties in economically resilient cities tend to fare better. Reference: Comprehensive Guide to Real Estate Risk Assessment of Verific. Don't put all your eggs in one basket. Diversifying is not just about owning properties in different locations. It's also about diversifying the types of properties you own. This could mean investing in both residential and commercial properties, or even diversifying into real estate investment trusts. Rights. Reference: Importance of diversification in real estate. A contingency planning. Preparing for the worst. Always have an exit strategy. Whether it's selling off some assets to stay liquid or refinancing to lower your monthly obligations, planning for contingencies will give you options when you need them most. Introducing Recomco, your partner in real estate investment. When it comes to safeguarding your real estate investments, nothing beats expert advice. We recommend consulting with Recomco, a service specializing in providing personalized investment strategies based on cutting-edge market analytics. Recomco offers a suite of services from risk assessment to exit strategies, and their track record of helping clients navigate economic downturns is unmatched. Visit Recomco, Real Estate Investment Service. In these uncertain times, safeguarding your real estate investment requires proactive strategies. By understanding your risk profile, diversifying your portfolio, and preparing for the worst-case scenarios, you'll not only mitigate potential losses, but also position yourself for future gains. And with expert services like Recomco, you're never alone on this journey. By implementing these bulletproof strategies and leveraging specialized services, you're taking important steps to navigate through any economic storm.